Thanks, Lou. Good afternoon, everybody. If you're here earlier, you had a chance to hear from the panel of esteemed investors focused on the equity or debt side of investing in private equity. So we thought it made sense to just follow that with a little perspective from professionals that traffic and specialize from the investment banking side in healthcare deals. So just by way of background, again, my name is Ken Hoyer. I'm a private equity investor working for a family office, Kidd & Company. We're based in Greenwich. We are generalist investors making control investments, lower middle market deals. We have one med tech investment today. We own a contract manufacturer of capital equipment and single-use disposables for medical device OEMs. And so I guess that's what qualified me to moderate this panel today. But what you're really here to hear from is the experts to my left. So with that, I'll have each of them just say a few brief words of introduction, and then we get into some prepared questions that I have. But obviously, if you have questions on the topic and we want to make it as interactive and informative and helpful to those of you in the audience, so not knowing everyone's specific perspective, feel free to chime in, and we'll try to make it interactive and fun if possible. So with that, Lance?
Sure. Lance Carr, Senior Vice President at Houlihan Lokey, Middle Market Investment Bank, numerous offices across the country and Europe. Been with the firm about 10 years, primarily focused on valuation opinions in the healthcare sector, mostly servicing private equity-backed institutions, whether it's valuation diligence, things like that. That's primarily where I sit.
Great. Good afternoon, everyone. My name is Rich Bland. I'm a managing director of Cantor Fitzgerald. Cantor is a privately owned investment bank with 11,000 employees in the U.S. and abroad. And I co-lead the physician practice management space for Cantor. Recently joined back in May of this year with a particular focus area around dental practice, ophthalmology, radiology, vet services, and some other sectors. I've worked in investment banking for almost 20 years across a number of different industries. Over the last 7-8 years have focused specifically in healthcare and in the PPM world.
Good afternoon. My name is David Bloom. I've been advising companies as a banker in M&A transactions for a little over 30 years. I spent the first dozen or so years working for a series of large investment banking firms, none of which still exist. I like to think that part is not my fault. 18 years ago, I co-founded Edgemont Capital. Today, we are 30 professionals. We are exclusively focused in healthcare. That is all we do. There are certain verticals within healthcare where we have particular expertise, given that it is a very broad industry. We are predominantly a sell-side M&A advisor representing companies in transactions between 50 and 500 million. And the areas where we have particular focus would include physician practice management across the spectrum, outsourced pharmaceutical services, so CROs as an example, pharmacy supply chains, so infusion specialty pharmacy, health information technology, post-acute, and some other ancillary areas.
Thanks. Ken Benton. I am the Vice President at Ziegler. I've been doing healthcare investment banking for about 10 years. Last 2 of those at Ziegler. I've worked for some other firms, actually historically done quite a bit in the hospital space. But at Ziegler, I focused quite a bit on some areas including home health, managed care, give you a little background on Ziegler as a whole. It's very well known, certainly most well known for its senior living practice, but has about a 35-person group I'm in that's focused on healthcare services and healthcare IT on the for-profit side, and focuses on physician practices, behavioral, healthcare IT, or some of the other areas in addition to the ones that I mentioned that I cover.
Great. Thanks, guys. So there was some talk earlier on the panel about physician practice or provider consolidations, and you heard that's the background of several of the panelists, and everybody in healthcare hasn't touched provider practices. I think last year there were 84 new platforms in that space. It represented about 80% of the private equity investment dollar by volume in the U.S. So At the risk of just dumbing it down and spending a few minutes a little more granularly on provider practices, David, maybe can you just from a high level kick off sort of what's entailed broadly in the provider practice subsector, and then we can get into a little bit more specifically about some of the things each of you is seeing as sort of played out or opportunities.
Sure, happy to do it. So in our view, we're in the midst of an evolution from physician ownership, where it's an equity model where physicians actually have some level of ownership in their practice to a model where most won't have any. We're moving to an employed physician model, and we are moving through that transitional phase. Our thesis at Edgemont is that this will eventually apply to pretty much every specialty. People follow the dollars, so they've started at the places where the economics are most compelling and are sort of, again, moving through various of the specialties. There's several factors at work. One is a demographic play where physicians are looking to exit. Now there's an opportunity for them to do so with value, or before you literally just retired and somebody took over your spot. Because of this, new physicians moving into this space are almost all just employees. This is creating an opportunity for investors to help fund or finance this transition and move to more of a corporate model. At a fundamental level, what folks do in terms of structuring these deals is they look for an opportunity to reduce the existing compensation of the group as a whole to a market rate, and take the differential between what the group is earning and where the market compensation level is, and essentially transact that as your cash flow. And that's really the earnings stream that investors are buying. The business thesis behind it is to create efficiency. That with scale, there's a lot of benefits that accrue to the practice around best practices, purchasing power, negotiating with providers, and ultimately preserving leverage. So in a nutshell, that's how we see the sort of business case for what's happening in the transactions in the physician space.
Rich, maybe just to follow on, David mentioned scale as being important. As you think about the shift to more pay-for-performance or value-based care, maybe touch upon where you think we are in that continuum or that shift, and the importance of scale and being able to adapt to that.
Sure. So we've been talking about this broad transition from fee-for-service to value-based care for several years at least, and we're slowly migrating that way. And I think that's actually one of the key drivers behind the desire for groups to bring in third-party capital to be able to have the access to money to invest in their businesses as they continue to grow and migrate to value-based care, which is more of a risk-taking or compensation for performance type model. A lot of the doctor groups are too small. The independent docs don't have the ability to invest in the appropriate levels of infrastructure, in technology and compliance, in billing, coding, to be able to do this on their own. And so this is another vector that's driving a lot of the consolidation in the world today.
Anyone else care to just weigh in on where we are in that continuum of that shift to value-based care?
Sure. I mean, a couple of the areas that I've been focused on, certainly in home health, PDGM has been on everyone's radar this year, and in the SNF world, PDPM, is rolling in October. So, a couple areas where there's just been that steady migration to looking more at individual patients and outcomes rather than volumes. It's the traditional focus.
So in the world of sort of consolidating physician management groups, again, as a generalist investor, we don't have an investment there, but would you recommend for me to get into owning and rolling up a dental practice? Are there subsectors of sort of specialties that you think are less played out or more opportunistic in today's environment? And what are really the criteria for folks that are thinking about coming into owning some sort of physician practice today?
I'd say as a generalist investor, there's a number of different ways to play physician practice management and do so in a de-risked environment. I think we raised dental as one particular area. There's a long track record in certain specialties of private equity investors investing in particular sub-verticals within physician practice management, such that you can deploy a blueprint that's been battle tested for many, many years, versus maybe coming into a new specialty like orthopedics is an area that's gotten a lot of attention in the last 12 to 18 months as a new vertical in which private equity is pursuing. So there's different pockets of capital, there's different levels of expertise, there's different skill sets, and I think there's an alignment that needs to be carefully thought through as where you want to play healthcare, what is your skill set, what is your historical involvement, and then deploy the capital that aligns across those spaces. So for people that have been investing in healthcare in kind of the front of the curve type situations, I would recommend things like orthopedics or new areas that haven't had a whole lot of consolidation historically. For generalist investors, I would say more of the retail-facing healthcare that has a long track record, such that you can look at the successes and the challenges, frankly, and be able to design your investment thesis around it as one that's probably more practical for a generalist investor.
And I think I might add to that, as you're looking to deploy capital in terms of maybe a first platform, you want to think about, what your acquisition pipeline is, what are the opportunities to roll additional acquisitions into that, as well as potentially combining it with some sort of tech-enabled healthcare IT business that allows you to achieve the efficiencies I think everyone's looking for. So I think it's not only, what is the asset I'm buying, but how am I thinking about how I'm going to impact the growth and trajectory of that asset by combining with others over the whole period.
Can anyone else weigh in on, sort of unique angles, technology perhaps overlay or in combination with physician practices as a differentiator, either that comes with an asset you see or potentially combining them in some sort of vertical integration?
Yeah, I mean, my perspective is a little bit like, don't try this at home. I mean, if you haven't invested in the healthcare space and certainly haven't, pursued, trying to achieve scale in a physician practice, there's a whole sort of industry of folks who have been working in this arena for a long time and have, as you said, kind of employed pre-tested plans that have worked in the past, and there is some applicability across spaces. I think that, if you're looking to sort of, as an entry point, I think there's a few alternatives. One is to try to partner up with somebody that has that experience and has done it before and act more as a co-investor and whether they need your capital or not, to kind of learn at their side, a little bit of an apprenticeship. Or two is to find industry expertise, to find folks that you think really know what they're doing and leverage their skill set. So even if it's in like a new physician specialty that hasn't seen a lot of investment historically, is to try to find a group that you think operationally has some excellence that you can scale and bring that for the benefit of others and really leverage that expertise. I think IT is potentially one component, and certainly in a value-based environment, IT is an absolutely critical component. I think if we continue the conversation along physician groups, however, it's a whole range, a whole spectrum of best practices, of which IT implementation is only one component. And I think it's being able to develop a well thought out thesis that you've seen actually operationalized that you can then scale. And I think if you're a naive investor to the space, either doing that in partnership with somebody that's done it before, and or make sure that your platform, if you will, contains some real differentiated expertise. Otherwise, I think you're in for a lot of long nights.
Sure. Yeah, I was going to say, just to turn to the original question on the dental specific example, actually working with a company right now that was initially pursuing a generalist dental strategy and has now switched to more of a specialist endodontics focus. And a couple things. I mean, first of all, it's harder to differentiate yourself if you're competing with other, a very well trodden model. But in addition to that, if you're going out and buying a whole bunch of specialist dental practices, and a lot of other people have approached these dentists over the years, your entry multiple is going to be higher, which is going to be harder to achieve any sort of arbitrage on the back end. So that's another thing to think about. But but also the more niche you go, certainly not to say it's easier, but there's more opportunities that there might be certain market characteristics that are differentiated and unique versus going for sort of a strategy that's one that many people have done.
Lance, I know you've done a lot of valuation work for add-ons and some of the buy and build strategies. Can you maybe talk about one that you've seen successfully played out and integrated, and one that maybe hasn't gone as well as the sponsor would have liked, and maybe compare and contrast what you think has worked versus, sort of with the benefit of 2020 hindsight, what maybe went wrong on another one?
Yeah, I think in terms of what's went well, I think it comes down to diligence, as well as I think having the right operators, the right management team in place. I think those companies that are more able to successfully execute on the strategy when a private equity fund finds an asset that they want to pull into the platform, I think that's going to be the most impactful. And then in terms of, I think it's exactly almost the opposite situation when you don't have, where I've noticed, rolling management team where it's not consistent, not focused. That's when I've seen lack of value creation, if you will, and sort of staying at the potential entry multiple and not being able to achieve that optimal exit.
So we focused so far predominantly on physician practice management or doctor practices. Are there any other sectors that you guys are particularly see as in favor today or out of favor, just because they're played out or the consolidation that has already happened, or where are you seeing opportunities just in other sectors of healthcare broadly?
Yeah, I think where we see a lot of activity currently is in the outsourced pharmaceutical services sector. I think on the earlier panel, Scott mentioned the clinical trial services as one subsector within that space. But I think the whole industry that has rapidly scaled to support pharma and biotech increasingly in terms of the development and approval of novel therapeutics has created an enormous opportunity. Really on the heels of the successes that you see in the biotech space. There's been record amounts of capital that have been invested to support innovation in biotech and pharma. And those drugs need to go through a development process for approval. And the industry that has emerged to support that development has really, I think, benefited from a lot of those trends. Historically, you had a big integrated pharma company that did everything internally. The model these days is much more towards a virtual company, which, as people say colloquially, is two guys on a molecule, but you really can outsource pretty much the entire continuum of services needed to take a drug pretty much all the way to approval in the current market, even though these days you probably won't get there because you'll be selling at some prior stage. So this is a huge service category. It's approximately a $65 billion industry today. And we see record amounts of deal volume, valuations, and capital really focused on that space.
Sure, happy to talk to some of the areas I work in. Home health, certainly it's actually hard to even find a good size asset that a good size regional player that's for sale. There's only so many of those processes a year, so we try to get in on those. But yeah, I mean, you see private equity buyers or other buyers actually putting multiple practices together because it's hard to find good sized assets that would be attractive to a PE firm. Certainly on the managed care side, if you have a managed care company and a certain number of lives for sale, you're certainly going to see a robust process. But back to the home health, yeah, I mean the multiples tend to be double digits, and the public companies in the space are actually 20 in the 20 range. So definitely that's been a hot sector as people look to move obviously to the lower cost providers on the spectrum.
Any other sectors maybe wants to touch on? Or?
I think just generally speaking, in terms of sector, I think with the emergence of IT, you're seeing the ability for subsectors to be impacted and be changed into different types of businesses, whether it's a home health business that's now being merged with a tech-enabled analytics business to help with reimbursements on Medicare Advantage programs. It's changing the way that businesses are working, and I think if you can think through what might make sense and achieve synergies on both sides of the table in terms of having both sides of the business work together, I think that's an interesting strategy. I think you're seeing a lot of it with the bigger CVS Aetna, for example, sort of cross-industry M&A. I think that's another way. It's not industry specific, but it's a way people are changing the value proposition for companies overall.
And just to touch on one other element, and I spent all my time in the physicians world, but kind of piggybacking on the topic of different ways to play something that's been invested in for 25 years, to go into a subspecialty vertical within a subspecialty is a way that a lot of the investor communities are trying to think about how to play something that's been invested in for a long time a little bit differently. Last year, I advised a traditional way dental service organization on a recapitalization with a private equity firm, and a major driver for the level of interest in that business was a teledentistry aspect to the business, such that they were able to deliver dental care to patients in need who had access to care issues inland in California. And so that element of the DSO made it attractive to a subset of the investor world that kind of put it a little bit in a unique scenario.
Sure.
I have a question for Richard and David. Your thoughts on concierge medicine, growing numbers of doctors that are going to cash models and value-based care across the country, whether it's in the hospital system or independently. Any thoughts on rolling that type of industry in?
I think and I haven't spent a ton of time in the space, but I've seen small pockets of concierge medicine, but not with such significant scale that it's been a focal area for investing. So could be an opportunity for people to get out in front of it a little bit more. But I think conceptually the model makes a ton of sense from the patient perspective as well as the provider perspective.
Yeah, I don't have a lot to add. I mean, our thesis at Edgemont holds the same, which is, round numbers, we think 90% of those physicians are going to be employees, and the other 10% are going to be cash pay to those that can afford it. And like much of the rest of society, you'll have that segmentation. Our bias is to go more towards where the numbers are. I think there are some real opportunities to create some unique service models there, but if you look at the demographics and where the dollars are skewed, it's really to the employed physician model.
Sure.
I stand up, otherwise you can't see me. Dr. Chitra Durai, AI scientist, CEO of Opus, and we are appearing at the panel next panel. We all talked about subsectors of healthcare in terms of payers, providers, and genomics, and so on. How about looking at it from a consumer demographics, for example, aging 52 million, 65 years and older in America, the next 11 years, another 18 million as the last cohorts of the baby boomers join the 65 years and older. By 2050, it's going to be more than 70 million, 2060 it's going to be 98 million, and so on. So the numbers are staggering, and the world sees similar kind of numbers. I don't know whether there was an interesting tidbit. Last year, 2018, was the first time in human history, I'm going to underline that verbally, the whole aging pyramid was broken. The number of 65 years and older exceeded the number of 5 years and younger. So what you're having is a demographic change which is double barrel rather than the usual aging pyramid. So given that, my interest in, are you seeing activity in terms of investments or merger and acquisition, in terms of what some people call aging tech, silver tech, and so on?
Yeah, I mean, the place where we see that most concretely is in Medicare Advantage. We're very close to the numbers that you just cited, and we are big believers in simple concepts and and the law of big numbers. And yes, I think one of the overwhelming trends for healthcare in the U.S. and a lot of the Western world, but we're talking mostly about the U.S. here, is just, yes, this demographic evolution. And yeah, I mean, we are increasingly headed towards some sort of crisis in this country where we're going to have issues around affordability of healthcare dictated solely just by the demographic. So I think the major initiative to address that you're seeing taking hold today is Medicare Advantage. I would have answered differently. I would have said ACOs maybe a couple of years ago, but you're seeing large private investors invest enormous sums of capital to greenfield Medicare Advantage plans. And I think any capabilities, technology, and support to help onboard patients into these MA plans and to develop more sophisticated analytics to be able to more effectively manage the cost of treating these populations has a huge potential for value creation.
And I think that's sort of the gist of where the explosion behind home health businesses have come from as well, because they're going to be the primary, or one of the more primary places of where services are delivered, rather than historically it's been in a hospital, doctor's office, things like that. So I think that's one of the points of it as well.
Sure.
Piggybacking on that, will there be enough doctors, and will they be good enough, and will that affect years down the road? But private equity firms and bankers are focusing on that.
Yeah, these are all themes that support the tremendous amount of capital that's being injected into the healthcare services world today. I mean, the aging population and the shortage of physicians create a double impact, if you will, in terms of the inability to be able to service this growing part of the population, and why we need to make the investments into healthcare services to be able to create organizations that are able to better manage more efficiently this increased population, because there aren't more doctors coming into the system.
If there are more physician assistants and nurses that are taking some of those responsibilities from doctors. So there is some efficiency that is being created.
There's countervailing trends, right? So trying to push it down to lower level professionals, lower degree professionals is one, and I think technology is the other. So I think people really, Rich's point, trying to leverage telehealth and other initiatives. One specialty where it's actually going the other way would be radiology, where there's huge advances in AI, and I think that will help sort of supplement the countervailing trend in terms of shortage of physicians. But there's other specialties where, yeah, there's going to be an acute shortage. In the near term, it creates huge value creation opportunities for investors because it's an underserved, and so you can increase the pricing. But longer term, it creates some challenges for sure.
To that point, are any of you seeing opportunities in long-term care type facilities or anything going on there of interest? We talked about the treatment, but how about just the housing and the general support services?
We don't. So this panel has spent a lot of time in long-term care. I would say the general answer is no, not so much. People don't want to go into those facilities any longer, and so even though the population is aging, there's I would say strong push to other types of models. So again, it's going to, I think, create more opportunity for home health. I think assisted living and those types of care models. But I think most of the investment dollars these days that are seeking higher return are focused on asset-light models. And the facility-based model is much more of a real estate play than it is a healthcare play in the current environment.
Actually, touching upon that shortage of doctors issue, one of the other things I've been seeing is some of these newly minted doctors also care about their actual lifestyle, So I have second cousins who they are practicing as locums, They want to practice for a couple of weeks, and 1 or 2 weeks they're traveling the world. So with that in mind, I mean, and they're tech savvy too, not just the physicians, but also the patients / customers, right? So are you seeing, telehealth is one aspect, but are you seeing any other technological advances which are making this whole as a service model come into care delivery?
My view on that is more than technology, it's a business delivery model. We see health physician staffing as much more of a bigger force in the market overall today. And that's what's driven a lot of the consolidation in the hospital-based groups. So, I mean, most emergency rooms are, they're outsourced. The hospital leases the space to a third-party company or, assigns the management of that emergency room to a third-party company that is staffing in physicians who are, either full-time or 1099s or W-2 hourlies. It's changed the entire, I think, employment model for physicians. So to my comments earlier, we see the same thing. A lot of med school graduates today are not going into medicine for the money. They're going into it because it's a real passion to be a care provider. And it's also with an understanding that there is much more flexibility in terms of the model these days where you can be a part-time physician and practice medicine effectively. There's a higher proportion of women graduating from medical school today than men, and they very much see an attraction in that sort of model. So I think it plays into the physician consolidation where companies that provide physician staffing or lower acuity or lower degree professional staffing services have enormous opportunity because you can employ that professional in a whole continuum of care model. They can be in a hospital, they can be in a facility, they can be in the physician office, they can be behind a computer on a telehealth platform. And ultimately what you're doing is you're leveraging the expertise of that medical professional.
Yeah, we're actually working with a company that provides physician house calls, and that model is starting to make a little bit of a comeback anyway. And some of the doctors, what they say is, working for a traditional practice doesn't give them the opportunity to really, spend the time with a patient that they'd like to, and that really leads to an attraction to sort of a different, more flexible model. And yeah, with people coming out with more debt, more female workforce, people are looking for different kind of opportunities compared to the traditional, owning a piece of your own practice model.
These are all drivers in support of the consolidation because people coming out of medical school or dental school, they have the debt burden, they want the lifestyle, and they don't want to worry about their business when they leave the office. And so they're much more attracted in today's environment to group practice or consolidated or large institutions than maybe setting up their own office and running their own business as they were 20 years ago.
But I think also one of the things I was reading recently is there's a huge focus on customer-centric healthcare, which is the consumer or myself or my whoever's taking control of the healthcare decisions. Everything needs to be run through the patient, and so you're seeing sort of a step back of physician services in terms of what they're providing potentially day to day in terms of through a complex situation. But you are seeing with other sub industries a focus on how to deliver better to the consumer or the customer to allow for them to manage their own care needs as well.
Since you guys are so involved in a number of sell-side processes and have for a while, I'm curious, as a prospective buyer, when I lob in an offer of 12 times and I don't even get invited to a management meeting, what's really going on in these processes? Is the market as frothy? Is there that much capital being deployed? Are you guys that good at your jobs at creating this demand for these assets? Can we just talk maybe anecdotally about some of the goings-on in the various processes in today's buying environment and the sell side, what you guys are experiencing? Is it strategics and financials competing against each other? Or is it just a lot of private capital looking to be put to work? I'd be curious, just without naming names, what can you share in terms of some of the recent behavior within these auction processes?
I'll kick off maybe with the dynamic that I'm seeing around the competition levels. So you brought up strategic. I'm actually seeing platform investment multiples far exceed what a strategic would pay in most instances, depending on obviously the subspecialty and area of healthcare services. But what you're seeing in today's world is the private equity capital that needs to be deployed is willing to potentially overpay by a turn or two or three on the multiple because the consolidation opportunities, across a myriad of industries, is so vast that they can buy down that multiple over time. And rather than have to, compete in 7, 8, 9, 10 different processes to find that one situation that's maybe, the more attractive to them, they'd rather deploy the capital early, maybe pay a turn or two higher today, and then work that multiple for that business down and get paid over time through consolidating smaller, single practices at 4 times or 5 times EBITDA. So it makes that 13 or 14 times EBITDA entry multiple look a lot smaller, over the whole period.
I'm sort of David's comment of don't try this at home, right? It's everyone sort of comes into this with a strategy of the bolt-ons, but then also what other types of assets am I merging into this platform to create additional value opportunities to either price up the multiple by saying, well, I'm not really this type of business, I'm actually this type of business now. And that's, I think, just to add quickly what we're seeing in terms of the activity of the deals that I'm working on from a valuation perspective.
I think a lot of these folks that are participating in these processes and winning these processes, to be competitive, recognize you need to have a thesis. It's more than just, okay, well, we're going to outbid everybody else and then we own this thing and now what do you do with it? Of course, that does happen from time to time, but the majority of folks are coming to having invested the time and resources to do the research, to know what the opportunity is. So secure the platform, and then the physician groups that are trading at these premiums, it's not just about capturing the arbitrage between what you paid for the platform and trying to roll in a bunch of little guys. That's part of it. But it's what are your additional streams of revenue? What are the ancillaries? So a lot of the ancillary services that are concomitant with the delivery of the E&M, the practice, give you an opportunity to generate incremental revenue that wasn't available. So when you have the platform and now you're adding on these smaller groups, you're a lot of times introducing these ancillary streams of revenue to groups that haven't had any of it in the past. And then you're bringing certain best practices, you're bringing purchasing power. Oftentimes you can onboard the billing and collections, you can centralize the scheduling. There's a lot of synergy. So it sounds very dramatic. It gets a lot of press. Such and such sponsor. Can you believe? The whole thing. They didn't get to the next round at X 15 times or whatever it is. But the folks that are winning is they don't expect that they're going to be holding, to Rich's point, something at 15 and hopefully the multiples will go to 50 one day. It's having the average down, and it's not just an acquisition arbitrage game, but it's looking holistically at that therapeutic area and what's the overall economic opportunity over time.
Yeah, I totally agree with the comments on this subject. But yeah, I mean, I've also seen private equity firms with the goal of opening de novos too when they acquire a business. So anything to sort of make it more, that's going to make it more creative over the lifetime investment.
Hey, you guys want to brag about your highest multiple achieved for a client?
38 and a half, it's public.
Nice.
Burner Dental.
I think we probably had some that
Could you
have
please
gotten.
repeat it? I'm sorry, you couldn't hear.
38 and a half. That's the high water mark. Ken?
I was going to say, I've probably had some that have gotten in that range, but it's usually because the company's performance has dipped during the investment process.
You're supposed to retrade. That's what we did. How about so as a buyer, I'm sorry.
So how do you factor in risk to wonderful opportunities?
Can you be specific about what kind of risk? There's a myriad of risk.
You're putting your money on the table and there's a risk involved.
Well, that's kind of where I was getting to that point. As a more value-based buyer, we're never going to compete at that level. I would be more drawn to looking at assets that have a little bit more hair on them. Maybe it's customer concentration, maybe it's smaller deals, maybe there's something about the asset that's just not going to generate that level of competition. So what are some of the risks inherent in some of the assets you guys that maybe it's a more troubled process, maybe it's a broken process? What are you seeing ultimately for the prevailing buyer that's maybe not willing to play at that level? What kind of risks are you seeing them take today that maybe they weren't 5 years ago?
I'm actually seeing the opposite. I think the investor community's gotten very educated around how to structure around risk. So for instance, there was a big transition a few years ago in the physical therapy world with out-of-network rates coming into in-network and impacting a lot of the organizations. Well, that's a type of risk that you can structure around these major migrations in the business model for the organization that the investor is investing in, and maybe you do something around structuring the deal, the compensation, the cash flows to be able to make the deal attractive for the organization and de-risk the equity and the debt investors, such that they're not going to be exposed to any big major changes from a reimbursement perspective.
Yeah, I guess we'll back to your original question, where process where there was a major customer concentration issue. There's definitely a lower middle market company where you tend to see that, and there was also regulatory concern, and I just saw number of private equity buyers. A lot of times private equity buyers are looking for sort of that bogey they find, and then they move on. But one or two parties kind of hung in there and are looking to potentially sign a long-term contract with one of the major customers, and you're looking to do some add-ons that'll reduce the concentration. But basically they're going to find themselves in a process that doesn't have quite the competition of some other ones, and might have an opportunity to pay a lower multiple. So definitely, I think the ability to be flexible, certainly can still have value.
Yeah, I mean, I've seen earnouts, to the conversation that's had in the previous panel, earnouts tied to terms on new contracts that you're signing with something that was negotiation during a transaction. I've seen significant rollover equity with liquidation preference protection. I've seen incentive plans that many of these private equity firms put in standard. So to Rich's point, I think everyone's getting pretty smart about how to manage it, and then you're going to see a less sophisticated process, but then more potentially incentive on earnouts or things like that.
So I guess the moral of the story is if we have customer concentration, reimbursement risk, and maybe somebody died in the chair, we could possibly pick something up for 10 times. I mean, the aside is we, as separately, we're investors in an RV dealership. So as you guys are doing your job keeping everybody alive longer, I'm hoping all these old people live to buy a lot more RVs. And, I don't know if there are any other questions from the audience. We're kind of getting down to time, but go ahead.
Coming back to the kind of the plenty of opportunity for consolidation, is there any, like, even on a geographic basis, because medicine is often local, are you seeing any big platforms bumping up against each other? Is that driving any of the value growth? Like, so Florida being somewhat of a hotbed for the aging population, dermatology in the more sunny climes of the States.
Yeah, I mean, my view on that is actually it's kind of crazy, but in the current environment, it actually facilitates higher value because, part of the thesis that you're communicating to investors is, listen, there are these several platforms and you have this sort of path to exit, right? So you're getting in on, but you know that the state is consolidating, and so there's ultimately going to be a winner in the state. It could be you, it could be somebody else, but it's going to help to elevate valuation overall. So I actually think that geographic consolidation helps to actually facilitate appreciation and value as opposed to, the opposite.
They're not necessarily avoiding each other, because I think you mentioned earlier there was 50 plus platforms launched this last year, but it's not like statistics in dentistry. Only 15% of the practices in the offices are one or two offices, so that kind of illustrates just how much opportunity there is.
It's still extraordinary fragmentation, even when you hear all these options. Because the groups, when you talk about the groups, they have 20, 50 doctors, they get to scale, they have 100 physicians. You're like, wow, that's a giant group, right? But like one of the largest anesthesia groups is like 250 physicians. I don't know, it's like 600,000 licensed physicians in the US, and another several 100,000 nurse practitioners and mid-levels. It depends on the specialty. I'd say the hospital-based ones are a bit more consolidated than the office-based specialties, but there's, economic, macro conditions aside, there's still tremendous, I think, ground to be covered in terms of the physician consolidation.
In hospital-based practices, any activity there? I know 5-6 years ago there was a lot of hospital system consolidation, but I feel like it's gone very quiet. And then I'm hearing that physicians just don't want to work for these big academic medical practices. Any kind of changes? In Philadelphia, there's a number of big practices and a lot of consolidation. Anyone getting real savvy? Any tide turning?
I think anesthesia is pretty well played out at the moment. I think those valuations are relative. They've come off quite a bit of their highs. And there's not a lot of transaction activity. The big public companies have done a lot of consolidation. I think, the natural order of things is the multiple was driven by acquisition activity. And so, it becomes self-limiting when the activity drops, and it becomes sort of the cycle dynamic where valuations drop, you do less M&A, and valuations depreciate. I think that radiology still has some legs, and so we still see a lot of opportunities. A handful of platforms in radiology still making a lot of acquisitions and driving up values there. But the other hospital-based practices, emergency and anesthesia, pool. I think if you look at healthcare over the years, it sort of plays into these familiar cycles where there's a huge consolidation wave. It's usually focused around large geographic demographic centers. And then over time, people look for opportunities in less dense populations, and so it starts to gravitate into the rural communities. And so we see potentially opportunity in the early stages in anesthesia and emergency in some, more rural parts of the country, having some, smaller but still meaningful opportunity. But the lion's share of the transaction opportunity or the transaction activity that we're seeing these days are in the office-based specialties, and it's pretty much there's a wide range. We've talked a lot today here, people about derm and ophthalmology. We're seeing tremendous interest in GI, ortho, we're going to see a psychiatric group next week. If the themes are there around ancillary revenue, demographics, being able to reduce the cost of care through the model, gain efficiencies, leverage with payers, it applies to a broad range of therapeutic areas, and in some cases even primary care.
Well, thank you guys. Appreciate all your insights, and